Hello, in today's video we'll be taking a look at the Friday, March 20th trading session for the SPX index utilizing the day trading GPS SPX daily key levels V 3.0 indicator, which is the newest version of this indicator just released about 4 weeks ago. Okay, so in today's session we have one trade that has gone for a $960 profit per option on the scalp and $2,440 profit per option on the ideal two-level minimum move down to the S2 level. Okay, so starting off here, we have our indicator giving us the alert on the 9:30 a.m. bull bear key price level. You have a close below the bull bear key price level, and this close is within the acceptable range for a bearish trade on the bull bear KPL. So how you do that in the indicator, you simply go into the user control panel. Before the session starts, you go down here to the alert section and you have enable BBKPL 9:30 opening candle close alert, candle close above or close below alert, apply range filter. As you can see here, now it's popped up. And it will pop up in real time on that first candle close. The acceptable range percentage is set to 85%. You can set it lower than that. 85% would be the maximum you would want to have the acceptable range filter set to. And as you can see here, it's giving us that this candle is within the this candle close is within the acceptable range, and the close is below the bull bear key price level. So that is a opening candle bearish signal entry alert for a trade off the bull bear key price level. Now in today's session, we're not going to do what we regularly do, which is run through all the three option strikes that you have with this indicator that you can take on any bullish or bearish trade. You can look in the description of this video to look at the general overview video as well as the new features video of the V 3.0 version. And there's also links to longer SPX session videos where we go into more detail about the daily key level strategy that you use trading either 0DTE or 1DTE options for day trading SPX with this indicator and this daily key level strategy. So in today's video, we're just going to run through this one trade. If you are interested in learning more about this indicator, then please look in the description of this video for those additional links and watch the other videos. Okay, so we have our opening candle bearish entry signal alert here on the BBKPL opening candle at 9:30. We're on a 2-minute chart, and that is the recommended chart time frame for utilizing this daily key level strategy with this indicator. You can also use chart time frames of between 1 minute and 5 minutes if that's your preference. However, we have found the 2-minute chart time frame for this particular daily key level strategy to be the best within that 1 minute to 5 minute chart time frame range. Now the standard play, there's 3 option strikes that you can utilize on any bullish or bearish trade with this indicator. What we're going to show you today is just the standard play. There's always going to be 2 other out of the money strikes. I will show you how that is done in this video, but we are not going to track all the other ones in this video like we do in our other videos. Okay, so the way that you do the standard at the money play on this trade is that you look to the level you're taking the trade from. In this case, the bull bear KPL level, which stands for key price level. 65.8851 is today's bull bear KPL price. So you're looking for the option that is closest in that price, either a 0DTE or a 1DTE option. We're using 0DTE or 1DTE because we are day trading these options. We're opening and closing the position all in the same session. So this indicator is not meant for swing trading. It is made for day trading, for intraday, intra-session day trading only. So you'll be opening and closing any position all within the same session. So therefore, you would not want to use anything outside of 1 DTE for that purposes, because then you're just paying too much for time value, which is not going to have any relevance in this session at all. You would only use 1 DTE if that's your preference, if you want to play with the options through the entire session, especially later on in the session. At the beginning of the session, there's not going to be much difference between using the 0 DTE or the 1 DTE up until you get around 11 to 12 o'clock. Then it does make a difference. After that, as far as playing into end of day, as far as opening up any new positions. Okay, so here we have the 65.90 strike. That's the closest strike to this. We're using a put option. We are buying on the close of this candle because we want to confirm where this opening candle is going to close and that it is within range. If the candle was out of range, then no alert would show up. So since the alert is showing up, we know it's within the acceptable range set by the acceptable range filter. If this does not show up, then there's no trade on the BBKPL for the opening candle. If this had instead been the opposite candle and had closed up here on above the bull bear KPL on the 9:30 a.m. opening candle, then you would instead see a green alert for a buy signal on the 9:30 a.m. opening candle. If that candle had closed outside the acceptable range, then there would be no bullish signal on a close above. So the range filter keeps you from getting into candles that are way too extended for the risk reward profile on the bull bear KPL. Keep in mind, with this indicator, you can take trades off of all the other main key levels as well. The main key levels are the bull bear KPL, the R levels above, which are R1 through R6, the S levels below S1 through S6, and the contextual levels, which are the pre-market high, the pre-market low, yesterday's daily high, yesterday's daily low, and yesterday's daily close. All three of these Y levels are RTH session values. So this is the high from yesterday's RTH session, the low from yesterday's RTH session, and the close from yesterday's RTH session. Okay, the close of this candle, the 9:30 ask, is $27.70. So for one option, that's going to be $2,770. If you're doing multiple options, you would simply multiply that times the number of options that you're trading. So if you were trading 3 options, then it'd be 3 times 2,770. We do have elevated volatility at this time due to the war, due to the oil prices, and some other factors. So these option prices are almost twice as expensive as normal if we were on a low to moderate normal type of volatility environment. Then this 2770 would be more in the $12 to $14 range. However, we're in elevated volatility right now, so it is fairly expensive. This indicator also works on the SPX mini index for those that like to trade SPY. The XSP is the SPX mini index. It trades very similar to SPY. And the mini SPX index trades at 1/10 the value. So this option on the XSP SPX mini index would be approximately 10% of this price. So you could trade, for example, 10 mini SPX XSP options for approximately the same price as one regular SPX index option. So for those of you who are SPY traders, you can use this indicator to trade XSP, which does pretty much mirror SPY. Okay, so we have the entry at 2770. With this indicator, there are 2 different types of trades that you can do. One is a scalp trade, and the other is what we call a regular trade. The difference between the two trades is on a scalp trade, you're looking for a quick in and out. You're looking for a one level move in your favor, and then you are exiting the trade 100%. Versus a regular trade, you're looking for a minimum 1.5 level move to 2 level move in your favor. And then at those points, you can either exit 100%, adjust your stop loss to break even or break even plus a profit buffer on all of your contracts. Or if you're trading multiple contracts, then you have a third option, which is exiting 60 to 90% of the contracts that you started with for a profit, and then at either the 1.5 or 2 level move in your favor on the regular trade. Then you can leave remaining runners. Those remaining runners, you adjust the stop loss to break even or break even plus a profit buffer. And then you can, if you still want to stay in the trade with the remaining runners, you then manage those runners level to level if price action continues trending in your favor. The stop loss on this trade, the QL above the level that you're trading on a bearish trade is the tight stop loss. Or if you want to use the standard stop loss, it is the first midpoint level above the level that you're taking the bearish trade from. So in this case, we're taking the trade from the bull bear key price level. So our standard stop loss is the first midpoint above, which is this level here, is notated here. And our tight stop loss, if you prefer to use that, is the QL level above the level you're taking the bearish trade from. On a bullish trade, it works exactly the opposite. On a bullish trade, the QL below is your tight stop loss, and the midpoint below the level you're trading is going to be your stop loss on a bullish trade from that level. And it works the same on the other main key levels, the main R levels and S levels. If you want to use the tight stop loss, you simply turn on, depending on whether it's a bullish or bearish trade, the QL level above or below the level. And if you want to use the standard stop loss, then you simply turn on the midpoint level above or below the main R or S level that you're taking the trade from. As far as default, the default settings are that the midpoint and QL levels above and below the bull bear KPL are turned on by default. The other levels you turn on manually as far as midpoint levels or QL levels in the user control panel for the other levels. As far as taking trades off the pre-market high, pre-market low, YDH, YDL, or YDC levels, that is done in a separate section in the user control panel in which you would select either a tight stop loss or a standard stop loss, which I can show you right now. So here in the user control panel, you would simply scroll down towards the end. And you'll have stop loss and take profit levels for PML, PMH, YDL, YDH, and YDC. You have individual controls for your line extension options for the take profit, enable, and stop loss lines. And you also get line labels for those if you would like to utilize trades on that level for your stop loss and your take profit. Then you simply go down to either the bullish section, which is the beginning section, and select the level that you would like to take a trade from. All 5 levels are here. If you're taking a bearish trade, then you simply scroll down further to the bearish section, and then you can select which level that you want to take a trade from. And then what you would do is you go ahead and you select by checking. Let's say if you wanted to take a bearish trade off of the pre-market low, then you would select either to use a standard stop loss or tight stop loss. Then you can select your line width and line style if you want to do something different from the default. Then you would enable your take profit. The take profit default is a reward risk multiplier of 2. That's $2 of reward for every dollar of risk with your stop loss. The risk reward multiplier goes in 0.25 increments all the way down to 0.25, or you can go above the default level of 2 in 0.25 increments all the way up to 30. Okay, so we have our two different types of trades, scalp and regular trade. Scalp trade is a one level move in your favor. How you calculate the one level move in your favor, you take the level you're taking the trade from, in this case the bull bear KPL. The direction of the trade, in this case, is down. The first full level down from the level you're taking the trade from is your scalp exit. That's S1. And here on the 9:56 a.m. candle, we have a hit of the S1 level. That is your scalp exit. As you can see here, we have the bid on the candle close of this candle here at 9:56, and the final bid on the close is $37.30. That is a profit of $960 per option on that scalp. So if you were trading one option, that would be a profit of $960. If you were trading 10 options, then that would be a profit of $9,600. Of course, you also have to subtract out any commissions you may pay to your broker and the clearing fees, of course, from the CBOE exchange for options. Okay, so on the 10 o'clock a.m. candle here, which is this candle here, it takes out, now you can't see, this is sort of blocked by the candles here, but this is the YDL level and the PML level. So these are in confluence with each other and they're very close to this midpoint level here. It takes out all three of these with one candle. So this is your minimum threshold 1.5 level move in your favor. So here we have a one level move for a scalp. The next midpoint down in the direction of our trade is this midpoint level. So that's your 1.5 level move in your favor. That is the minimum threshold for a regular trade. The ideal minimum threshold for a regular trade is the two level move. A two level move would be, this is one level, 1.5 level. S2 is 2 levels. That occurs here on this 10:20 a.m. candle. So this would be the minimum ideal move. The difference between the minimum required 1.5 level move and the minimum ideal 2 level move is, generally speaking, in most sessions, the most that you're going to see in about 80% of the sessions is a 2 level move. So most of the time, trading is going to be confined between R2 and S2 on most days. So even if you were taking a bullish trade from S2, which we're not getting price action dictating that at the moment, but if you did take a trade from S2, then, and that was a bullish trade, then a 2 level move back to the bull bear key price level would be a 2 level move in your favor on a bullish trade from S2. If you took a bullish trade from S1, a 2 level move in your favor from S1 on a bullish trade from S1 would be back to R1. If we got a bullish trade later on in the bull bear KPL, off of the bull bear KPL, then a 2 level move would be up to R2. So on most days, as stated, on about 80% of the sessions, you're going to see price action pretty much be the extent of R2 down to S2. Then you'll have outlier sessions will extend beyond that, especially during extreme volatility, where we could see R3 down to S3, or R4 down to S4, or R5 down to S5, or even R6 down to S6. On inside days, which are mean reversion days, then you're generally going to see more of a R1 down to S1 type of scenario in those type of days. But in about 80% of most sessions on SPX, most of the trading is going to be contained within S2 to R2. So that is why we have the 1.5 level move for a regular trade, or the 2 level, and that is the minimum required move, or a 2 level ideal minimum move for a regular trade. Okay, so on this hit here, we have the 1.5 level move to mid S1, S2. So on this hit here, we have the 10 a.m. bid on this candle, $44.60. So that is going to be a profit of $1,690 per option. So if you were getting out here on this minimum required 1.5 level move, then you would be getting a $1,690 profit on this trade. And if you were instead just adjusting your stop loss to break even, what that means is not moving your stop loss level down to the level that you traded from, or even the level that the trade was executed at. What that means is that if you're moving it to break even, you are then changing your stop loss to a price level stop loss, meaning the price that you paid for the option. So the initial stop loss is the SPX price level based. However, when you're adjusting your stop loss to break even, or break even plus a small profit buffer, then you are adjusting your trade based on your stop loss on the trade to the price that you paid for the option. So that's an important transition for you to understand, that if you're not doing a scalp where you're just getting out at the one level move in your favor and you're doing a regular trade and you're adjusting your stop loss either on all your contracts or just on your runner contracts, that you're then changing your stop loss from now being a price level based stop loss to a simple price based stop loss, the price being the price that you paid for the option for break even, or adding an additional amount on top of what you paid if adding a profit buffer. Okay, so as stated earlier, here at the 10:20 a.m. candle, we have a hit of the S2 level. The bid on that candle close of the 10:20 a.m. candle is $52.10. So that is a profit of $2,440 per option. So as stated, on most days, you're going to have a two-level move as the fullest extent. So therefore, when it hits the two-level move, you would want to, at that point, tighten up your stop loss on any remaining runners if you already adjusted it here, because of the fact that in a lot of sessions, like we said, 80% of the sessions, for the most part, there's always outliers, but in about 80% of the sessions, that's going to be the full extent, R2 down to S2. So if you are going to stay in the trade and keep any remaining runners, then you want to keep a fairly tight leash on these remaining runners. And then if price happens to keep going down like it is at the moment, if you have any remaining runners, then you can still either exit those remaining runners at further moves in your favor, or keep adjusting the stop loss and keep continuing as price, if and when price continues to trend within the session in your favor. So in that case, if you were therefore seeing if price was going to move down to a further level in your favor, you would go into the user control panel, and let's say here we would turn on S2, S3 is the midpoint here. So we turn on S2, S3 here. And so this becomes an additional waypoint. If price happens to come down and touch here, then you would have a situation where if you had any remaining runners, you would either further adjust your stop loss here to add more of a profit buffer, or you would take off some of your remaining runners and just adjust a stop loss on whatever remaining runners you have left, or you can simply just exit all the remaining runners here. If price continued going down, then the S3 level now becomes your additional waypoint for another decision should you still have any remaining runners here. And that would continue down. If price did continue trending throughout the rest of the session, then you would simply turn on mid S3, S4 and repeat the same process. Okay, so some of you may be wondering, well, how does this indicator work for the people that are using it and using this daily key level strategy? So what we're going to do here in a second is we're going to show you screenshots of feedback that we've received and reviews that we've received on our daily key levels indicators from traders that are using the indicators. Before we do that, I'm going to tell you that if you would like to purchase this indicator, you can send us an email at daytradinggps@gmail.com to request a discount promo code to purchase this indicator, and we will send you one in return for you taking your time today to watch this video. All right, so now we'll look at the feedback and reviews from traders using the daily key levels indicators. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you. Just a quick note, if you are interested in purchasing this indicator, in return for you taking your time for watching this video, you can send us an email at daytradinggps@gmail.com to request a discount promo code to purchase the indicator. Thank you.